Good day, fellow investors. As I'm always researching, updating, I'm currently researching the FTSE and updating it for my research platform, and I came across again Anglo American that is down 48% over the last 9 months. So as I'm always looking into the commodities, you can read a lot about that on my research platform. I just wanted to dig a little bit deeper into Anglo American, see what is going on with the dividend yield and the market capitalization, whether it is cheap or not, and given that it is a diversified miner, to see whether there are already any opportunities into the commodity sector because of this big fall. So here it was all about the commodities supercycle, Goldman Sachs discussing how you must own copper and everything, and as it usually happens, people lose money, but as long as Wall Street gets their profits. I'm more of a conviction that you should look into commodities when nobody wants to look at them, not when they are selling you supercycle fears. It's better to look at commodities when they sell you panic, recessions, and they tell you to sell. But let's look at Anglo American. I just updated a little bit my document here, and this chart also shows what it does mean to invest in miners. When things go bad, things get really ugly. Now we have had really good times, and now we are slightly coming back to normality. So diversified miner, which means it tells you a lot about the environment and everything, and as Charlie Munger says, it is always better to understand what's going on in the world by looking at businesses and how those businesses are breathing rather than looking at news headlines. So we are doing exactly that here, looking at Anglo American. They are a very stable business, so they have the Beers diamonds. I would go for the fake ones because they look the same, so if it is important how it looks, then go for the fake ones. If it is important for something else, then run away. But okay, that's my idea. Copper, they are going to increase copper production and then have it a little bit stable. Okay, nickel stable, platinum a little bit lower, iron ore, let's say stable, and still making coal even increasing a little bit. As we can see, platinum has been higher, but it is like a choppy ride, nothing spectacular, but still making money for the company. And if we look at the presentation and their results, production is higher, but because of prices, revenue is a little bit lower, unit costs haven't escalated despite inflation, and they still made EBITDA of 5 billion in the first 6 months of the year. So Quellaveco ramped up, and you can see here that unit costs are low, because if you can produce at $1 and sell at $3.5, you always make money in whatever environment. Politics, diamonds, it's all about politics. So they have a new 25-year mining agreement and sales agreement. So that is okay. They still have some debt, but low compared to EBITDA. They are paying that dividend yield and keeping that dividend per share and reinvesting EPS to keep the production stable and grow. 41% EBITDA margin, usually within the mining environment, when the EBITDA margins are 40-50%, it means that the sector is still going strong, that prices are good, and they are making okay money. But of course, it isn't what it was a year ago with much higher prices, so they have lost 50% of their profits due to weaker prices. And there is also some inflation that pressures those costs higher for miners. They have still very high Capex requirements, also for growth, but also for sustaining, and EBITDA doesn't include Capex. So if they make 10 billion for the year, spend 6 billion on capex, something on interest rates, etc., there isn't much for free cash flows. 2-3 billion, compare that to the 30 billion market capitalization, and yes, you are a P ratio of 10, 15, or better to look at cash flows, 10. Okay, it is something, but not miraculously enough for investing in miners. You want that cash flow yield to be on an average cycle above 20% to have a margin of safety. But yes, if you're looking at the long-term trend for these minerals and everything, it is looking good, even still making coal, because few are investing in coal, so you can make some profits there depending on the cycle. But in general, the demand for these products is likely to be there for longer. Thus, it is a good company with good long-term assets. Nothing wrong with the long-term investing thesis. As the world keeps on developing, especially emerging markets, reaching developed market, life quality and everything, copper per person will increase, steel and whatever. So the future is bright for such miners. However, we have to get them at the right price. They have the opportunities to grow, especially if copper prices allow that. And here you can see guidance for the year. Of course, they are not telling you how much cash flows they will make. Miners always tell you, this is what we will produce at these costs, this is what we will spend for capital investments, and then depending on commodity prices on the market, you can calculate your earnings by yourself. And you can see here the production growing for copper, then stabilizing again, and others are pretty much stable. And you can see here the unit costs. I don't think that copper will go below $2 anymore. So PGMs might go lower, so they won't be making money. Here, if it goes lower, they will make some here, a little bit less here maybe. So iron ore, they have the cost in line with all the other producers. So except for a recession, they should make something here. So they are not in danger of not surviving, which gives you a margin of safety. However, if a recession comes, they will not make a lot of money. And you can see here the earning sensitivities if prices change. Iron ore prices are still pretty high. If you consider that their cost of production is 40, those should stabilize around 60-70, so they are still making money. If there is a recession or something, this will come down, and then it will be the time to look at. Copper prices have subdued a little bit since the bubble and super commodity cycle Goldman Sachs titles, but still high compared to the costs. If there is a recession and something, we could see maybe 250 again, and then it will be the time to pound. Now, when it comes to these investments, what I do and what I do on my research platform, I wait till the right time comes. It might come once or twice in a decade, and then it is when we will bounce. That's the strategy. So no hanky-panky trading, chasing super cycle trends. No, just waiting for margins of safety in the commodities environment. So the stock is down also consequently because everyone expected the super cycle. The super cycle, now everyone forgot about it, but still not yet a great buy. A good buy, perhaps if you have a diversified portfolio, want to start with it. Commodities can go up and down, but you have to be ready to increase exposure if it goes lower. Don't forget to check my research platform if you are interested in more value investing, waiting for that commodity cycle. You can also read here my copper investment thesis, updated in line with what's going on with the markets, and then you can understand how to better play the commodity cycle. Thanks for watching. I'll see you in the next video.